In this video, I will review the latest updates from Chuck Akre's portfolio. He has retired, but still that's his fund. So the new generation is here to manage his portfolio. And on Dataroma, as you can see here from the latest 13F, you have a few updates. Some buys, some sells, and when I say some buys, I mean some meaningful buys. Companies that I know very well, so it will be pretty interesting. I just want to comment on the situation because this is a very hunting ground. If you are a quality investor, Chuck Akre or Akre Capital Management or all the people surrounding this fund are great inspirations. These are our role models of quality investing, and I believe this fund is maybe the ultimate quality fund. Maybe this one, maybe this and Valley Forge Capital Management. You are talking about the highest quality companies in the world. Buy and hold, and you sleep well at night. This is the definition of their fund. So pretty interesting picks. We will see what they have bought and what they have sold. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And when I say Chuck Akre is an inspiration, I have a wallpaper of Chuck Akre in my room, and I try to copy his investment style as much as possible. And this is the reason I'm making 25% per year, because of his great advice and his quality picks. So let's see what we have here. Let's see the portfolio and the allocation, because not everything is important. The first position of his portfolio are not changing. You still have MasterCard, you still have Visa, you still have Brookfield, you still have KKR. So you are talking about extremely well-run companies where nothing is happening. Okay? Same thing with Moody's, by the way. For the 5 key holdings of his portfolio, nothing ever happens because these companies are so well-run, are so predictable, are so sustainable. You have a clear runway of operations and nothing ever happens for these businesses. If you look at MasterCard, we are talking about a business that grows at 15% per year. The valuation is now reasonable and they are in a duopoly. They are enjoying very nice free cash flow margins. They are doing a little bit of dividends, a little bit of buybacks, and they are just getting more volume, more transactions, and that's it. They are the definition of a toll booth, in the world, in the economy. If the economy is improving, MasterCard will just get a royalty out of other people's behaviors. Same thing for Visa. Visa is a royalty company that improves as the world improves with zero cost. This is why their businesses are so good. This is why you don't have many videos on YouTube about Visa and MasterCard, because this is boring. This is extremely boring. Nothing ever happens. All the quarters, all the quarterly reports look alike. The business is just growing as usual. And every couple of quarters, you have a major disruption risk. Every couple of years, you have something new that is supposed to disrupt the payment industry. And guess what? Every couple of years, they are proven wrong because Visa and MasterCard are so entrenched in the world, nothing can disrupt them. And now in 2025, you have rumors of stable coins that will disrupt this industry. Well, people that say this, maybe they want to know more about the moat of these businesses. Maybe they don't really understand the competitive advantages that Visa and MasterCard have. Because this is not the first time we have this kind of risks. Every couple of years, we have a new major disruption risk. And every couple of years, MasterCard and Visa are embracing the new technologies. So yeah, this is why I wanted to start this video with Visa and MasterCard. Nothing ever happens. We are talking about extremely high quality names. And I'm very happy that he's just holding these positions, trimming a little bit to add more funds all the way. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Let me continue. You have O'Reilly Automotive, so an auto part business. The valuation has run up also. I'm also a shareholder of AutoZone. So O'Reilly and AutoZone are the two big boys in the industry. And if you look at the valuation for O'Reilly, it has gotten expensive and the stock has gone down. So maybe you will see in the next quarter what they do. But yeah, you have a minus 10%, minus 15% drawdown for this company. The valuation is still expensive, don't worry. You have a forward P ratio of 29:30. Historically speaking, O'Reilly was trading at 20. So yes, you are at 30 before you are at 20. So it has gotten expensive and I understand why he's streaming here. CoStar is not moving. CoStar is still in a good shape actually. You have an expensive valuation, but CoStar is in a very good shape. Roper has been trimmed. Oh, that's unfortunate. Airbnb is not changing. Airbnb is a very interesting pick that I think doesn't fit Chuck Akre's philosophy. Because Airbnb has an ecosystem for holidays, for experiences. But so far, the results have not been promising. If you look at the financials, if you look at the financials for Airbnb, this is not so great. The CEO has a lot of charisma. He has great plans. The margins are fine. The business model is fine. You get two cuts. You get a fee from the buyer, a fee from the seller. So it's a great marketplace. It's a great platform. But so far, the valuation is dropping and the fundamentals are not so great, right? You don't have explosive growth and you have a forward P ratio of 25 for this one. So yeah, wait and see. Maybe it will be a good winner in the long term, a great marketplace. When they IPO'd 4 years ago, they had an extremely high valuation. And as the fundamentals have improved, the valuation has gone down. So how low can the valuation go? It's a good question. If you think this is the bottom for the valuation, and Airbnb is a quality company that deserves a forward P ratio of 25, maybe now is a good time to buy. Because it's still a quality company after all. Yeah, I'm not interested in Airbnb at all. I don't like the business model, but I understand the marketplace. We will see. As they go into more experiences, they are broadening their services now. So we will see if that works out or not. It's a little bit too early to judge. Okay, now we're getting to the big buys. Last quarter, Akre Capital Management did two buys, two new additions to the portfolio. Copart, it was 0.5% of the portfolio, and FICO, Fair Isaac, it was 0.1% of the portfolio. They have increased these stakes meaningfully. Now FICO is no longer 0.1% of the portfolio, it's 4% of the portfolio. And Copart is not 0.5% of the portfolio, it's 2% of the portfolio. So a lot of optimism, very bullish, and very good news for all the quality investors. Very good news for all the FICO and Copart investors. Actually, FICO is a company I cover on my YouTube channel. If you want more videos, you can just type Fair Isaac FICO and you will find plenty of videos from me on this topic. It's maybe one of the best companies on earth because it's a monopoly and their moat is very wide moat. And they started buying this year maybe they bought at the dip that we had this year at $1,300, $1,400. And a couple of months after this, in September, FICO announced a new business model that would widen their moat. They will cut the credit bureaus and go directly to the consumer. In case you don't know what I'm talking about, and if you don't know FICO, they do the FICO scores in the US, right? So Fair Isaac is a little bit of a software company and also the company behind the FICO score. If you want to judge whether somebody deserves a loan or not, in the US, you are given a FICO score. If your score is low, You don't deserve a loan, so you will have a lot of interest to pay and low quality loans. And if your FICO score is high, you can get as many loans as you want. Basically, that's a clear, simple summary. And the FICO score is created based on, did you repay your old loans? Are you a good customer from the bank? These kind of things. And this FICO score is used by 98% of the banks in the US. And it has been the case for many decades. So the whole banking industry, the whole lending industry is created around this FICO score. And the way they gather data is by asking the credit bureaus. You have 3 of them. You have Experian, Equifax, TransUnion. And now FICO recently announced in September they don't want to gather data from the credit bureaus. They want to do it in-house. We are not sure how it will play out. We don't have much visibility on this new business move. But if they succeed, they will increase their margins because because now you have to give the credit bureaus a little bit of a margin for their efforts, because they work, so you get a little bit of margin for them. If they cut these credit bureaus and go directly to the consumer, they will improve their margins because you don't have to pay the credit bureaus, right? Now, the score segment inside FICO has a EBIT margin, operating margin of 87%. Let me repeat in case that's not clear. This is a business model with FICO. I told you have a little bit of software and you have the score segment. The score segment is the most important one for FICO. It has an EBIT margin, operating margin of 87%. This is a monopoly that is ridiculously profitable. Can you name 10 businesses with an operating margin of 87%? No, absolutely no, you can't. If you can, please use the comment section below this video to prove me wrong, but I don't think you can. So it's one of a kind. And the score segment is growing rapidly. You have a new change in regulation. You had a new change in regulation in 2018. Now you have much more pricing power and they can increase the prices of their scores 20% per year. They've been doing so, and now the margins are sky high. What if they continue to increase? What if the operating margins with this new business change go from 87% to 88, 89, 90, 91, 92%? I think it's doable. I think they can do it. They will be disgustingly profitable. It's a monopoly and they can do whatever they want. So of course it's a quality name. Of course it's a quality company. Of course they have pricing power. And of course it has a high valuation. This is why not everybody is buying this company. You have a forward P/E ratio of 43. Expensive. Now FICO just reported earnings a few days ago. They guided for an earnings per share growth of 26%. And if you look at the earnings report, they said that they were extremely conservative in their guidance. That tells you a lot. Because, you have a guidance of 25% growth, and you say you are extremely conservative because you don't know if this new business model of cutting the credit bureaus will work out. You don't have much visibility. What if instead of growing the earnings by 20%, they grow earnings by 30%? In this case, maybe FICO is not so cheap. Next question, what do you think the growth rate will be in 2027? Like the year after this, 2028. What if they continue to grow at 20-30% per year? This is maybe what they are thinking in Akre Capital Management. With this new business model or this new pricing power, what if FICO can continue to grow earnings at 20-30% per year for 5, 6, 7 years? It can happen. Now that you know this, you have a few risks to consider for FICO. You have a regulation risk. Before 2018, you had no pricing power. The new acceleration growing 20% per year is very recent, since 2018. Before that, you didn't have this. What if you go back to the old world of having a limited pricing power, back like you had back in the days in 2017, 2016? It can happen. Second question, what if prices go too high and the government doesn't like this? Can happen also. What is the odds of this? You judge. But yeah, you have a few risks to consider. Another risk is the valuation. This is maybe why I'm not buying FICO for my quality portfolio, is the valuation. I would love to buy it at a cheaper price because I did in the past. This is not the first time I'm monitoring FICO. I was a shareholder in the past. I bought Fair Isaac in late 2021. Here, when the stock dropped and dropped and dropped, it had a PE ratio of 25. So for all the people that say it deserves a high premium valuation because it's a high premium business, well, the valuation can drop, the stock can drop. In 2021, 2022, the business was still growing, but it had a PE ratio of 25. And I bought a lot of stocks at this time. Okay? So yeah, it can happen. Please don't be lured into thinking the valuation can't get lower. It can get lower. If you have a recession, if you have interest rates that go up for some reason, if you have a deceleration in the scores segment, if you have a deceleration in the pricing power, yes, the mistakes will get the mistakes will punish the stock immensely. The higher the valuation, the bigger the shock if you have a problem. If you have a PE ratio of 10 and you have a deceleration of the revenue, it's okay. People don't care. But if you have not the forward, but the current PE ratio is 60. If you have a deceleration of the revenue stream with the PE ratio of 60, the stock can fall 10% in one day. We've seen this happening when Equifax reported a bad press release on FICO. FICO dropped 10% in one day because they announced some new Vantage Score cheapness. Anyway, so yeah, something to monitor here. Very interesting, and actually I'm very happy to see Akre Capital Management buying more FICO. It gives more confidence to this bullish scenario of growing 20-30% per year. So looking forward to the next report to see if they continue to increase their position. So that was the biggest the biggest addition, and the most important update we had from Akre Capital Management. You have another buy that is that shows half as much confidence because it's only 2% of the portfolio. That's Copart. Copart is a quality name, family-owned company that has dropped, but the company is still fine. It's an online salvage vehicle auction company. Very old company that is dropping meaningfully. You have a deceleration of the business, which is the reason why the stock is down. But the revenue is still up and to the right. The net income is still up and to the right. The free cash flow is still up and to the right. So this is fine. They have no debt problem. They are filled with cash. And now you have some temporary problems for the company. This is it. And in the past, the valuation was extremely high. You had a PE ratio of 40. And I told you, if you have a PE ratio of 40 and you have a deceleration, boom, your stock gets a big haircut. And now the PE ratio is 25. The stock is down 35%. So it's still a quality name. It's still profitable. They don't have any debt problem. So yeah, maybe it's a good time to enter the position now if you are comfortable and if this stock is within your circle of competence. Copart is not inside my circle of competence, so I will not touch it. I understand much more Fair Isaac compared to Copart. But yeah, it's a quality name that is on sale right now. Yeah, it's very interesting. I mean, if you were hesitant to buy Copart, maybe now is a good time. I can totally understand people buying Copart right now because all the problems are temporary. And they doubled down, tripled down on the position. You have also Danaher, very interesting to cut their position by half at the same time as Pat Dorsey is reducing the position a little bit. Yep, the stock has done nothing for the past few quarters, but the operations are still fine. Danaher is a serial acquirer. They acquire many businesses. And yeah, things will be fine in the long term. Maybe they trimmed a little bit of Danaher to buy more FICO, to take the proceeds and buy more FICO. What do you think? Small additions, we are talking about 1% changes here in the portfolio. They are continuing to reduce the American Tower exposure. Too bad. American Tower is the most famous investment from Chuck Akre. It's a 100 bagger for them. Like, they have multiplied their investment by 100 by investing in American Tower, because they first bought American Tower, I don't know, 20 years ago, 30 years ago, 40 years ago. It was, I don't know exactly, but I think 20 years ago. 20 years ago. Like maybe after the dot-com bubble. I'm not sure. I have not followed this closely. But yeah, it was a big investment for them, and seems like the new generation of investors from this fund do not like this idea for the long term. So every couple of quarters, they are trimming the position, and now the position is meaningless. Last quarter, they reduced American Tower exposure by 60%. Now, this quarter, they reduced the exposure by half again. So now we are talking about peanuts. This is slowly disappearing from the portfolio. They don't believe in this company's future. Okay, so yeah, apart from this, you have some small, meaningless changes here. So yeah, that was the update from Akre Capital Management. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.